So 1 year protection, cheap due to higher rates. What am I talking about here? So one of the charts been doing the rounds out there on Market Ear or on Twitter, etc. Is Bank of America talking about how cheap 1 year put protection is, saying it's the cheapest since 2008. Now, whilst it's factually true what they're saying, it kind of implies that the options market is a bit complacent and that downside protection might be too cheap. Therefore, it's good value. There might be some signaling in that the market is, going to go down. And I think a more accurate analysis would take into account the fact that 1 year interest rates are at 5%. And that's the highest post-GFC level that we've seen in rates. Okay. So what do I mean? So when we were pricing a plain vanilla 95% put, which is basically what their analysis is on, right? So if we look here, they're saying the premium of the 95% put is the lowest that we've seen since 2008. Now, when you price an option, you've got to take into account what we call the forward price, okay? And the forward is a function of where the spot price is, but also rates and dividends. So in a world where we had much lower rates, forward prices were much lower. Now that we've got 5% per year rates, that takes your forward up by 5%. So if you're taking the forward up by 5% and you're pricing a 95% put, obviously it's going to be a lot cheaper than normal because the forward you're using to price it is 5% higher than it was. Okay, so that is what's providing a lot of this cheapness, just by virtue of the 1 year forward being much higher than it typically is. Okay, now the correct way to price protection and the real cost of downside is, and that takes into account the forwards and the implied vols, is to do it the way we do it in the 25 delta space, right? So if you looked at a 1 year 25 delta put and you compared what implied vol those 1 year 25 delta puts have traded on going back for a decade, you would see this chart on the right, and you'd see the lows were actually achieved in 2017, which shouldn't be a big surprise because vols were on their knees in 2017. VIX was sub 10 for a long time, but actually the implied vol on the 25 delta put now is closer to 20% as opposed to the lows of 15.85, which were back in 2017. So there's a material premium relative to those lows. So I'd say the downside protection is a fair bit more expensive than back in 2017. But obviously for people wanting to just hedge themselves from a 5% correction on the S&P or bigger than 5% correction, because your protection kicks in down 5% if you buy a 95% put. For people looking for that, yes, the premium cost is low, but just know that the cost is low because your forwards are really high. Okay. And I just wanted to make sure that major inferences about the price of vol and skew are not being made from these statistics that are being put out there. Because, people can misunderstand what these guys are saying and say, oh, vol and skew must be so cheap if this is the cheapest we've seen since 08. That is not the case. Okay. So my inference is that the market is not quite as complacent as this would lead you to believe. And just you need to understand the mechanism when you price options. Forwards also matter, and the forwards are much higher, which is what's bringing down the cost of those puts.